y'all, I'm back today with some quick tips. This is Professor Gail Moore for Accounting 201, and if it looked like I just got off a school drop-off line, you're right, I did. But I wanted to talk to you a little about posting to T accounts, okay? Because these are some things we didn't get to finish in class all the way, or for some of you that are in my online class, you may have some questions on it, so I wanted to go over them again. So remember, after you do your journal entries, see our journal entries here, right here? I'm going to move this way. Y'all see our journal entries? After you do these journal entries, remember our journal entries are just a chronological list of what happened over the month. So we start at the beginning of the month, or the beginning of the year, the beginning of the quarter, and we write down everything that happened. And that's a nice list, but what do we do with it? We can't look at that and figure out, oh, this is how much money we have in cash. So we need to take these journal entries that we've done and post them to T accounts. Remember, we call them T accounts because they look like a great big T, right? Don't make that hard. So it's just the same thing. It's debits and credits. It's left side, right side. You just move that debit onto the debit side of the T account, or move that credit onto the credit side of the T account. So here, we have a debit to supplies and a credit to cash. That means we bought $500 of supplies for cash. Supplies went up, cash goes down. So this is the journal entry that shows that. How do we post that? Well, the first thing that we do is we're going to take this debit to supplies and put it right here. We're going to debit the supplies side of the T account, left side. Then we take this credit to cash, and we move it down here, credit to cash, right side. Okay, then here we got $1,000 cash for some work that we did. So we're going to debit cash and credit revenue. Sometimes your book calls it fees earned. Okay, but so we have this cash and this revenue, and so we need to put those in T accounts. So we have a debit to cash, left side. We're going to put $1,000 on the left side. We have a credit to revenue, right side. We're going to put that $1,000 of revenue on the right side. And say these are the only journal entries we have, which would not happen, but say these are the only ones, and at the end of the month, we need to figure out what these balances are, okay? Well, supplies is pretty easy because we only have one $500 debit, so we're going to bring that down. It's a $500 debit. But for assets, it's debits minus credits to get the balance. And revenue is pretty easy, right? Because we only have a $1,000 revenue credit. So we're just going to pull that down. But to find out a balance in a revenue account, it would be credits minus debits. And then cash here, cash is an asset, right? Remember, assets normally carry a what? A debit balance. So for that, for assets, we're going to do debits minus credits, 1,000 debit minus 500 credit is going to give you a $500 debit balance in cash. Okay, so that's just a little update on T accounts. I just want y'all to see how this works. I want you to have this paper, this video that you can refer to. As always, let me know if you have any questions. You can always email me. You can come see me. I'm an LC262. That's true for my on-ground or online students. Come see me anytime. Email me. Or, you know, we do have tutoring in the Academic Success Center, and that's always a good resource too. So please let me know if you have any questions. Thanks. Bye.